Ever wondered how to achieve consistency in trading? Today we're going to explore some key tactics that can help. Trading, as we all know, is not a game of chance. It's a strategic battle where the spoils go to those who can maintain a steady hand and a cool head. But how do you achieve that consistency? How do you navigate the choppy waters of the market without losing your footing? Well, it all boils down to strategy. And not just any strategy, but one that's robust, well-rounded, and adaptable to the ever-changing market conditions. And that's exactly what we're going to discuss today. We'll be delving into three crucial components of a successful trading strategy: moving averages, Fibonacci levels, and demand and supply analysis. First, let's talk about moving averages. They are one of the most fundamental tools in a trader's arsenal, providing crucial insights into market trends and potential reversal points. By leveraging a combination of short-term and long-term moving averages, like the 50-day and 200-day averages, you can pinpoint the optimal entry and exit points with greater precision. Next, we'll delve into the mystic world of Fibonacci levels. Derived from the Fibonacci sequence, a mathematical concept that's found everywhere in nature, these levels help traders identify key support and resistance zones. Mastering the art of Fibonacci retracements can give you a significant edge in your trading journey. Finally, we'll unwrap the concept of demand and supply analysis. This is where we study areas of strong buying and selling pressure in the market. By understanding these zones, we can anticipate potential market movements and adjust our trading strategy accordingly. So there you have it, a brief overview of the three key tactics that can help you achieve consistency in your trading. Remember, it's not about making that one big win, but about steadily accumulating gains over time. And that's where these tactics come into play. Without further ado, let's dive into our first tactic: moving averages. Moving averages are a fundamental tool in technical analysis. They help us identify market trends and potential reversals. Think of them as the smoothing out process of the often erratic price data, giving us a clearer picture of the overall direction of a market's movement. There are several types of moving averages, but today we're going to focus on the two most commonly used ones: the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA gives equal weight to all data points, while the EMA assigns more importance to recent data. This makes the EMA more responsive to recent price changes, which can be a significant advantage in volatile markets. Now, how do we use these moving averages in trading? Let's start with a single moving average. When the price crosses above the moving average line, it's often seen as a bullish signal, indicating it might be a good time to buy. Conversely, when the price crosses below, it's often considered bearish, signaling a potential selling point. But we can take it a step further with a moving average crossover strategy. This involves using two moving averages, one short-term and one long-term. When the short-term moving average crosses above the long-term one, it's a bullish signal, suggesting an uptrend. And when the short-term crosses below the long-term, it's a bearish signal, suggesting a downtrend. It's also worth noting the significance of specific periods. For instance, the 50-day and 200-day moving averages are particularly watched by traders. The 50-day moving average is considered a key indicator of intermediate-term trends, while the 200-day moving average is a gauge of long-term trends. Remember, while moving averages can be a valuable tool, they should not be used in isolation. They are most effective when used in conjunction with other forms of technical analysis. That's all about moving averages for now. Next up, we're going to talk about Fibonacci levels. Fibonacci levels, based on the mathematical Fibonacci sequence, are another essential tool for traders. They provide a unique perspective on potential market movements, which can be incredibly valuable when planning your trades. Now you may be wondering, what exactly are Fibonacci levels? Well, these are horizontal lines that indicate where support and resistance are likely to occur. They're based on the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones. That's 0, 1, 1, 2, 3, 5, 8, and so forth. To use Fibonacci levels in trading, we first identify a significant price movement, whether it's an uptrend or a downtrend. Once we've drawn our high and low points, the Fibonacci retracement tool then creates key levels of support and resistance. These levels are typically set at the 23.6%, 38.2%, 50%, 61.8%, and 100% points of the price movement, reflecting the Fibonacci ratios. But what does this mean for you as a trader? Well, these percentages represent potential areas where the price could retrace before continuing in the original direction. For example, if the price of a stock increased from $10 to $20 and then retraced to the 50% level, it would be at $15. This is where the power of Fibonacci levels lies. By identifying these potential retracement points, you can anticipate where the price may find support or resistance. This can help you determine optimal entry and exit points for your trades. Remember, while Fibonacci levels can be incredibly useful, they're not foolproof. Like all trading tools, they should be used in conjunction with other indicators to increase accuracy and reduce risk. Now that we've covered Fibonacci levels, let's move on to our final topic, demand and supply analysis. Demand and supply analysis plays a critical role in understanding market dynamics and potential movements. By identifying areas of strong buying or demand and selling or supply pressure, we can anticipate market trends and adjust our trading strategies accordingly. Let's break it down. Demand zones represent price levels where buyers have previously shown strong interest. When price returns to these zones, there's a high chance that buyers will jump back in, pushing the price up. On the other hand, supply zones are areas where sellers have previously taken control. When the price revisits these zones, sellers may once again dominate, causing the price to fall. Now, how do we identify these zones? Step 1. Look for price swings. These are significant moves in price either up or down. Step 2. Once you've identified a price swing, look for a sharp reversal. This indicates a strong demand or supply at this level. Step 3. Draw your zone. The demand zone is typically the area between the open and close of the bullish reversal candle. The supply zone, conversely, is the area between the open and close of the bearish reversal candle. Remember, these zones are not precise lines, but rather areas where buying or selling pressure has historically been strong. Now let's talk about how to trade these zones. When price re-enters a demand zone, consider going long or buying. When it re-enters a supply zone, consider going short or selling. However, be mindful of the overall trend. If the trend is up, it may be safer to only look for buy opportunities in demand zones. Similarly, if the trend is down, it may be safer to only look for sell opportunities in supply zones. Demand and supply analysis is an invaluable tool in your trading arsenal. By understanding where buyers and sellers have previously shown strong interest, you can make more informed trading decisions and improve your chances of success. Now that we've covered all 3 tactics, let's move on to our summary. In trading, consistency is key, and achieving it requires a well-rounded approach. We've taken a deep dive into the world of trading today, exploring some of the most effective tactics to achieve consistency in your trades. A quick recap for those who've joined us on this journey. Our first stop was moving averages, these invaluable tools that help us identify market trends and potential reversal points. We've seen how using a blend of short-term and long-term moving averages like the 50-day and 200-day ones can offer us a sharper lens to spot entry and exit points. Next, we navigated the mathematical world of Fibonacci retracements. These are levels based on ratios derived from the Fibonacci sequence. As we learned, traders frequently use these retracements to pinpoint support and resistance levels, which can help in determining the best entry and exit points for trades. Lastly, we delved into the intricacies of demand and supply analysis. We learned that by identifying areas of strong buying and selling pressure, we can forecast potential market movements and adjust our trading strategy accordingly. Understanding these zones of demand and supply is crucial for making informed decisions in the market. In summary, to achieve consistency in trading, it's essential to have a well-rounded strategy. This strategy should incorporate the use of moving averages to identify trends, Fibonacci levels to spot support and resistance, and demand and supply analysis to understand market dynamics. Each of these tools offers unique insights, but their power is truly unleashed when they are used together, complementing each other. They provide a more comprehensive view of the market, allowing you to make more informed decisions and, ultimately, more profitable trades. Remember, mastering these tactics can increase your chances of success in the markets. Thanks for watching, and happy trading.